Association that has over 500 banks and credit unions that are members. We're an association like AAA, not an association like, we don't process any transactions, so we can't take over your processing when you leave here. Back then, we focused on ACH, New England ACH Association, direct deposit. You know, at that time, for me, that was cool. It was electronic payments. It was sexy. Fast forward to today, everything's smarter, faster, digital. Over the past few years, we've been helping our members look at different innovations for faster payments and some digital solutions for their account holders. In developing the program, I came across a lot of things, faster and instant payments. The clearinghouse, the Federal Reserve, MasterCard, they're all building solutions right now. To help my members expand, we started studying things like APIs, FinTechs, machine learning, all those topics, and bringing content to my members. I stumbled across the DCU Innovation Center. I stumbled across Mass Challenge and Meetup and various meetups throughout the area. I love technology. I loved technology when it was back then. I love technology today. It's cool. So I'm working on this program, looking for the right components to pull together. And you know, financial inclusion came up as a topic. And it came up, for me, it came up academically. It was like, oh, financial inclusion. There are some GOs that really skipped the whole bank core processing stage, and they skipped it, and they started using phones to transfer money. They started using QR codes to transfer money. That was, it's academically super interesting. But when, you know, there was this line I crossed. It was a paper by the Federal Reserve that had this problem in it, the $400 problem. It says, it's called the Report on Economic Well-Being in U.S. Households, and it identified 40% of respondents who said they would not be able to cover a $400 emergency expense. Would not be, 40%. That wasn't academic anymore. That was a real number. That was real people that couldn't cover that. So financial inclusion is now part of our programs. I am asking, this is, you know, odd to step out of your comfort zone, but I'm asking that the community think about additional resources around solving the $400 problem, partnering with financial institutions to solve it. According to the Center for Financial Services Innovation, consumers spent $173 billion on fees, short-term loans because they didn't have that money, and long-term credit. With this community in mind, with banks in mind as well, I think we could do some good. Enough of stepping out of my comfort zone. Again, I gathered this great panel. They have great ideas. I love their stories. I love what they're doing. I'm going to have them introduce themselves, and we'll start over at the end.
Yep, Brian Clark from the Federal Reserve Bank of Boston. Hello.
Oh, Julie Thurlow, President of Reading Cooperative Bank in Reading, Massachusetts.
Colby Ross, my company's Project Finance. We provide online and mobile banking software for banks and credit unions.
Vasilios Roussos, Managing Director of the DCU FinTech Innovation Center, a nonprofit FinTech accelerator that helps startups go from MVP stage to production.
And Brian, can you take it away with a little bit about the $400 problem?
Yep, so I'll get us kicked off because the $400 problem is a study that the Federal Reserve Board of Governors does once a year, and they survey, technically called the Survey of Household Economics and Decision Making, or as we call it at the bank, the SHED data. I think people sometimes look at me strange because I keep talking about my shed, and they think I'm talking about a small building. I'm not. So when the study came out a few years ago, I couldn't go anywhere without someone kind of pulling me aside or talking to me and saying, at that time, the number was closer to 50%. It was, I think, 49% of Americans could not come up with $400 if they were presented with an emergency situation without having to go into debt or sell something. And I think that was pretty unbelievable for two reasons. The first is that for a lot of folks, I think that the number 400 doesn't seem like an insurmountable amount of money where you would have to risk the rest of your financial kind of go into debt or pay more to access that amount of money. The other reason I think that resonated is because at that point it was nearly half of the population, and that really resonated. Those two things I think made that stick. I've talked to the folks down in DC at the board about, brilliant, how'd you come up with $400? How'd you come up with $400? They just, that's where they landed when they all talked to each other. They thought it was small enough, and they had no idea it was going to come back at that. It was really just one of those things that they, kind of, I'm not going to say lucked into because you have very highly trained economists, but they lucked into it.
Brilliant.
Yes. I always take credit for the brilliance. So I want to do a little bit of myth busting and what I call bias busting before I talk. So, the top line number is 4 out of 10 of Americans. I'm going to go through some statistics here. I'm not going to just read off statistics to you because you would be bored to tears. But I'm going to read a few, and then I'm going to talk about why we think it's important and what we want to do with it, and then I'm going to kick it over to Julie, who has done exactly why the Federal Reserve does studies, because we want people to take the numbers and make it actionable and help people. So digging into the numbers a little bit, 31% of white people have the $400 problem. 60% of black people have the $400 problem. 50% of Hispanics have the $400 problem. However, we're always presented with demographic data like that. If you were to randomly poll someone from the SHED data that had the $400 problem, it would be a white person. 51% of white people, 51% of the people with the $400 problem are white. So although blacks and Hispanics have a higher rate of experiencing the $400 problem, because the white population in the US is so large, they comprise the largest group of people with the $400 problem. I think that that's key. I talked with our researchers about that. The reason I had to look down for that is because I want to make sure I get the wording of that completely correct. I think sometimes when we hear statistics, we then create an image in our mind of what the problem is, and I want to make sure that we are completely erasing that from your mind. 1 in 5 people with the $400 problem is a college graduate. 1 in 5 people with the $400 problem makes between $100,000 and $150,000. I was looking at the numbers. First of all, I thought that these were wrong, so I had to rerun them a couple times. One of our analysts that does really good work in Stata, I thought this one was 100% wrong, and I definitely had to look a couple times. And this is one of my favorite statistics from the SHED, although it's not the most optimistic. So it's already 4 in 10. If you select for, do you have a job? Are you paid by a company? Are you employed and paid by a company? So you're not self-employed, but are you a working person? Probably direct deposit. 37%. It only knocks it down 2%, 2.5%. It's not a material difference. If you're working, you still have the $400 problem at the same rate that you did before with a very minor. So, with that comes opportunity, because that really gets people thinking, especially working in financial institutions, all right, I can work with this because there is at least income. There's something coming in. Hopefully it's a direct deposit because that makes it a little bit easier to split and do interesting things on the margins. But there's 2 things I want to take away from that. One, the fact that it doesn't change it, which I think everyone should think about. Don't think of this as people that aren't working. These are hardworking people that can't come up with $400. But that there are opportunities to engage them on the income. I think that there are definitely some structural issues around the income problems in America. That's definitely out there, but controlling what we can control for. I just wanted to talk about that a little bit. So you probably won't be surprised by this. There's a direct relationship between age and being able to handle a $400 emergency. So younger folks tend to have the $400 problem, and it slopes down pretty directly into age. I think that that's an important piece too, because there are a lot of financial institutions, especially more traditional ones, that are concerned about their ability to engage with potential customers, younger customers. And it's my personal belief, and this is the view of Brian Clark, not Brian Clark, Federal Reserve Bank of Boston, Paul sitting right here, but that if you engage with someone and you help them out when they're younger and they have a $400 problem, they're probably going to be more likely to stick with you as they move along. Probably, hopefully, the income scale, but the age scale. That's the one we can't control. and this probably won't surprise you either, if you have a plan to save, if you indicate in the SHED study you have a plan to save money, you're way less likely to have the $400 problem. That knocks it down to in the 20s. So that makes a huge difference. So knowing all this, why am I talking still? We decided, after people were pulling us aside at conferences and meetings and saying, is this true, that we need to do something about it. So working with an organization called Commonwealth, who used to be D2D, Doors to Dreams, we decided we would begin to convene mostly community banks, but there are larger regional banks and even large banks that come to this. Twice a year, we would kick off the $400 with the $400 problem, a presentation like I've just gone through, very brief. And then we would have folks come in either from, we had a presentation on prize link savings. We've had the banks present on how to tackle two problems at once. So we had a session on how to build credit and save money at the same time by doing kind of a self-lending thing. All with the goal of turning people away afterwards and saying, please go, try to tackle this, because the Federal Reserve, we can't do product design, but we can bring people together, we can get the right people in the room and try to tackle this. So I will stop there, because the really great thing about the Federal Reserve study is that it motivated Mr. Lowe next to me to get out there and change the world in a way that I can't. So what I really love about Reading, I think I say this every time we talk to a group of people, is that they're doing what traditional banking should be. They're reacting to what their customers or their employees need, and then changing it that way, and not just saying, we offer checking, we offer savings, we offer CDs, and if you don't fit in, see you later. So you're up.
I mentioned earlier I'm the president of Reading Cooperative Bank in Reading, Massachusetts. We're a mutual bank. We're actually owned by our depositors. So our organizational structure is probably closer to DCU than it is to a savings or a publicly traded bank. Starting from that point, in 2014, we, way before JP Morgan and Bank of America, we actually adopted the principle of shared value. The fact that you can actually create things and be successful as a business if you actually identify societal issues and try to create products and services to meet those. And so that's the mindset where we think of most of the problems. The Federal Reserve study, even before the $400 problem actually was raised up, another great research piece was the color of wealth in Boston. And I think that one was even more sobering for all of us to actually think about the disparity in savings and the ability. Think of what the world would look like if those numbers continue to be true as far as who got to retire and who did not get to retire, and what changes in our demography would look like. Again, the research does propel. You probably publish and wonder if anybody reads. Well, I do. So thank you for that, because it actually allows us to have some self-reflection. As far as the $400 problem, in addition to the Fed's research and the convenings that they've done, there was also an article in the Atlantic magazine that both my HR director and I had read on a Sunday. So we walked into work. We have a senior management meeting at 10 o'clock every single Monday morning. We came in, we both read the article. Did you see this? Did you see that? That's Monday morning, right? And we just were sitting around the table and we're saying that should not be. And then the giant aha was that the article was about middle-class Americans. It wasn't about, as you said, low-income families, single-parent households, or anything like that. It's middle-class Americans. And then the bigger aha was we were sitting in a building of 90 employees. And that meant that our employees are experiencing that. And we're bankers. We know how to lend. We get that. That shouldn't be a hard problem to solve. And so we, in a matter of a few weeks, actually put together a loan product, which we ran out of our HR department. And based on 400, we chose 500. So we'd cover all the emergencies for our employees. We'd run it through payroll. We'd advance the funds to them at 0 interest. They could pay it back in $50 installments every other pay period. Shouldn't be too much of an impact, but it would take the stress. And when you actually think about taking the stress out of your employee's life, that means when the car doesn't start in the morning, you don't worry about it. You know you're only taking one day off from work. to get the car to the garage, because you know that you have a resource that's going to actually fund that emergency so that you can get back to work and you won't be as stressed. And we know stress plays out many different ways through people's life, their health, their family, and other impacts there. So we rolled out the product. It was well received. And then we met up with Brian and Commonwealth, and Commonwealth volunteered to do, one of the things we did, just to back up, is we decided it's not our business what people's problems are. And we don't want people to have to walk into HR and say, my daughter this, so-and-so is sick. We didn't want that information. We wanted this to be an access point for them, which was totally private and personal, and if they shared, they shared, but we would never ask them any questions. So the $500 was issued to them within 24 hours, usually the same day within an hour. And so Commonwealth offered to come and survey our employees, again, anonymously, so that we could get some type of feedback. Does this product resonate? Is it meeting the needs? We had at that time, I want to say about 15% utilization across our employees. And what we heard back was it meant a lot to them. It actually told them that their employer cared about them, which these days that's really important when we're at as low unemployment as we are, to make sure that we're taking good care of our employees. They appreciated the fact that it was there. When people said that they didn't use it or they found other sources, one thing came loud and clear back to us is a car, and I wasn't aware of this, but a car repair on average is $700 to $800 now. So although the $500 met a need, it wasn't meeting the broader need, and so people still had to use a credit card or still had to borrow some money plus get the emergency loan that we were giving. So we actually ramped the loan up after the survey by Commonwealth to $1,000. We have about 28% utilization at this point, and people come in. What's also cool is that people come in for the emergency amount. They're not coming in for the $1,000, and they're not coming right back again for the $1,000 once it's paid in. They're coming for $842, and if they can and they can afford it, they're putting extra down and paying it off. And our next push is to convert that to a savings event. Some of the learnings, and the Fed continues to educate us, is people don't think they need an emergency account until they have an emergency. So as you pay off this loan, can you check a box on the single-page agreement that you'll pay it back? And once your loan is paid in full, we'll start funding your savings account so that you'll have a self-funded emergency, or God forbid, if the emergency is bigger, you have access to an emergency loan, plus you have the funds that you've actually saved in your account. So combined, you actually have a better protection. And we're also looking at whether or not this is now something that we can roll out to our customers in a certain structured way. The one thing, the tough thing is, and I don't need to tell the people that are developers in the room, it's tough to sell a product. We actually offered it to anybody who wanted it. We recently actually had an article in an op-ed by our HR director in the Boston Globe, again, offering the structure. We've actually had 6 companies that actually are doing it as well. But HR is not volunteering to do more paperwork. So the ability to actually automate and make something into a product so that it's deliverable and it's not adding to somebody else's homework and taking up their time, that's also important. And there was one other piece that I wanted to point out about it, but it's escaping me at this moment. So, so that's the product in total. And I guess the only other point that I will make is we are also we're actually opening a branch in a gateway city in Massachusetts later on. I'd probably be open next year, as long as the Fed approves our application. No pressure. But we're also looking at, and it is going back and understanding what the problem is and hearing from people. And I think the Commonwealth exercise really taught us a lot about going back and getting feedback so that things can be better. And provide better sources of data. Just listening to the community and the needs. CRA right now, the Community Reinvestment Act, really is directed at at consumers buying homes, and banks are measured on whether or not they're meeting the community need by a residential mortgage. But there's so much between going from being non-banked into a checking account, a consumer loan, a credit card, and all those things that actually allow you to build a financial house so that you then eventually can buy a home. So just building through that continuum is something that we need to do better.
I'll jump in.
Okay.
Yeah, I'm going to go first. So I think what Brian and Julie have said is absolutely true from the perspective. So I'm going to speak about the perspective of being the managing director of the DCU Center and seeing startups and aspiring entrepreneurs and entrepreneurs who are building products, what's motivating them, and the result of this survey. And the Fed putting this out put a major call to banks, which is what we heard from Julie, but it also put a major call out to entrepreneurs. And so many socially minded young professionals wanted to do something of impact and importance in their lives beyond just kind of building a for-profit company. And this fact very much resonated with them. And so we have seen dozens, many dozens of companies who have applied to the center or entered the center who are looking to solve this in different ways. And some of it is tactical. It's like Acorns, right? Some of it is education, it's literacy. We've got a company called LearnLux that focuses on millennial financial literacy. The Acorns model was adopted by a company of ours called Future Fuel that helps pay down student debt. And so all of these mechanisms are trying to get the hurdle rate down for people. And so the big question is, how do you do that in a way that makes it easy and seamless and rewards people to conduct actions that they otherwise wouldn't do? So DCU, for example, to help solve this, said for your first $1,000 in your savings account, we're going to pay you 6.5% in interest, right, to motivate and do that. And that certainly created an uptick for folks. But that's not necessarily going to influence all folks. So we started to think about what more can DCU do, and what more can these startups do. The issue with these sort of passionate, motivated entrepreneurs is, how do you build a business around this, right? How do you take great technology in a product and potentially something that's influential and make that a going concern? And that's a significant issue. And a lot of people have sort of struggled around that, and it forces them to maybe shift left or right to be and maybe give up on that dream a little bit. What was very rewarding and what we were able to do with Colby here is Colby came into the center focusing on helping people with their sort of financial goals and aspirations through his consumer product. DCU was very much focused on creating a new next generation online banking platform that accomplished its goals to help its members in their financial health and wellness, and also address this problem about the $400 savings account. And so can there be a win-win that's structured, right, that makes sense for the startup and makes sense for the institution? And that the genesis of this idea is what started the conversation with Colby. And it resulted in coming up with some software that rewards and enables people to think about savings in a different way, right? And to make it easy to take action on savings. And if you don't reduce these hurdles, and you make it tough for someone who's not doing some things in the first place, it's never going to get there. And we've got folks who are doing behavior modification through financial incentives here. And we have ex-MDs and doctors who are also working on financial health products. And what's interesting is if you look at somebody who's in public policy, if you look at somebody who's a doctor, any of these analogies, whether trying to quit smoking, trying to treat obese patients, pretty much the same percentage of people are motivated to overcome these big hurdles, who are kind of on the fence, right, who will overcome these hurdles with training and support, et cetera. And then there's the vast chunk of us who, outside maybe one or two strengths that we have, are pretty bad at other things. So you might be good at exercise and really bad at financial planning, or pretty good at weight loss, but pretty bad at X, Y, Z. And so that's just a human dynamic. So how do you hack that human dynamic to help solve this problem? We've got one company called Envil. They're a challenger bank. The way that they're addressing it is through an AI that automatically saves information and puts it into buckets to tell you, hey, this is how much you have in your discretionary budget, and you're actually only allowed to spend this much. So that's kind of a more extreme example to sort of condition people into spending. The question with Colby in DCU is, how do you take 800,000 members in a traditional banking experience and give them these nudges? And that's what we've spent a lot of time talking about. How can you make that onboarding experience seamless? How can you take people's, in an economic society where everyone is driven by these dopamine rushes. So Amazon, I don't even want to wait 2 days now. It has to be next day, and now next day isn't even enough. I've got to get that shopping item today. Everyone is conditioned to do whatever it takes to get that urgent satisfaction. Saving, you don't really get satisfaction out of saving an extra couple of bucks today, right? So how do you create sort of software and an experience to give people that little dopamine reward to do what's in their best interest? So that's the part I think we're thinking about in the proactive part. There's obviously the part that Reading is helping out on is, hey, once you get into a bad situation, what's the best and healthiest sort of possible way that we can help you get out of that bad situation so it doesn't snowball into something really terrible. So with that, I'm going to kind of hand it over to Colby.
Yeah, it's cool. So yeah, again, my name's Colby Ross. Love that product, and we'd love to help you build the automation to that. So I guess I'll talk about sort of my 3 hypotheses around why there is a $400 problem, and this is really stemming from me being one of 5 people exiting college and having that issue. So the first one, I think the sort of systemic problem here is not one that is not saving. It really is around overspending. As sort of human beings, I think we all probably overspend too much and don't save enough. And I think we all sort of have this cognitive bias that we're richer than we actually are. And that sort of tends to hit us every other Friday when we get our paycheck. And I'll give you a real world example of this. And it's a personal example of me graduating college. I'm out at Best Buy. I just moved in to an apartment with some of my friends. And I'm looking at a $500 TV. And I had $2,000 in my bank account, and I said, well, $500 is a lot, but I've got $2,000 in my bank account, so, I can afford this. Is going to be really cool to bring a TV home to the guys, and, it's going to be great. In reality, I didn't have $2,000 in my bank account. I had $900 because the next day I had a Comcast bill due, I had a Verizon bill due, rent was due 3 days later, and I hadn't gone grocery shopping for the week. So that $2,000 was really $900. And once I bought that TV, I was down to, the $400. So if anything happened in my life, my car broke down or I had a medical emergency or something were to happen, I don't have a lot of money that, I don't have that buffer there that's going to save me. 2 days later, my car did break down. At the time, it was $600. So it was, this was 10 years ago, I guess, inflation. And I had an overdraft of $200 in my checking account. And this is not an uncommon situation in America. This is something that people face, and I think this is relevant in the stats that you were mentioning earlier. So the problem there is sort of the static nature of your bank account. When you look at your bank account balance, it's a static point in time snapshot of how much money you have today. And it doesn't really tell the full story of your financial life over the next week, the next month, the next 3 months. And as humans, and especially me as a just graduated college, I had an incredibly difficult time to understand all the inflows and outflows of my paycheck coming in, bills going out to eat with my friends. I had a really hard time keeping track of how much money am I going to have on a day-to-day basis to live the lifestyle that I wanted to live. And what I realized was, and this is sort of how we're starting to address some of these things through our software, and I don't claim that this is a silver bullet or anything, but this is just one way we're trying to address the problem, is by making the bank account balance more dynamic. And so we have a tool, patent pending, that we call Future Look. What Future Look does is show people the future of their bank account balance based on the cumulative effect of all the spending and saving choices that they're making today. So we've got machine learning models that go in and identify the individual's paycheck. We can identify discretionary spending. We can see what they're paying towards loans, credit cards, et cetera. And then we actually forecast that bank account balance out into the future based on all that activity that we're seeing. And so what this does is it allows people to make financial choices and decisions, spending choices and decisions, with a lot more clarity and confidence, because they can see the effect that it's going to have on their bank account balance at any point out into the future. One thing that we've seen with just rolling out Future Look to when we did it with our consumer app is a 38% reduction in planned spending as a result of seeing where their bank account balance would be out into the future, and a 20% reduction in actual spending. So again, this isn't a silver bullet, but we're pretty optimistic about the possibilities of Future Look helping sort of address some of the overspending, the overspending problem that a lot of us have, and hopefully not get into that issue where you need the $500 loan. Another way that we're using Future Look, and this is with DCU, is to be more proactive and notifying people of potential overdraft situations. So using the same technology, this is a customer that's logging in, and they're going to get a recommendation of a daily spending budget because we're noticing that September 20th overdraft of $45 is extremely likely. So the Future Look tool can be used sort of strategically, more in planning mode as people are considering spending and savings decisions, but we also use it proactively to notify customers and members of potential peril on the horizon. So that's sort of the first hypothesis. It's not really a savings problem, it's an overspending problem, and we're using our Future Look tool to try to address that. The second hypothesis is that there's tremendous confusion and anxiety around paying down debt. So I spent about 8 years working at Bank of America, and after my experience there, I went out and got all my series licensing, 7, 63, 65, and I started moonlighting as a registered investment advisor. So I registered in Massachusetts and New Hampshire, and I really wanted to just go out and learn about how people were managing their money, the problems that they were facing, the goals that they were saving for. And I was targeting a population of people that made less than $45,000 per year. I was just really interested in that sort of group of people. And one of the common things that I had learned from going out and talking to about 100 people was this sort of this desire to pay down their debt, and in particular student loan debt. I was talking to a lot of people that were my age at the time. And if you're making less than $45,000 per year, you qualify for the student loan interest deduction, and you've essentially got an interest-free loan from the federal government. And the people that I was talking with and working with were plowing all of their discretionary income into paying off their debt and not into it building in their emergency savings. And so just by talking to people, educating them, and helping them understand that, hey, you've got this interest-free loan and here's why you really should have emergency savings instead, I was able to actually correct that behavior and help people build their savings accounts. And so it was this learning that I sort of took and turned into more of a software-based approach that we have in our online banking solution now, where we actually provide advice and guidance around the most optimal financial choices and decisions that people should be making. So through our software, you can link external accounts. This is actually my Nelnet student loan account, where the recommendation here is to pay the minimum due, and you can see, my goal right now is to build an emergency savings fund. And I can engage with that recommendation and learn why that's the case for me. Then the last hypothesis around this is that there's just too much friction built into savings today. And as I was thinking about kind of what I was going to say today, I went on to Bank of America. That's still my primary financial institution right now. And I set up a savings goal. And it took me 13 clicks to figure out where I go in to set up that savings goal. So it took 7 clicks to set up the goal, and then I actually had to go into the savings account 6 clicks later to set up a contribution. That's way too much work for the average person just to start saving. So what we've done with our application is made it super easy for people to, one, know what they need to be saving for. So when you open our mobile app, the home screen is actually the goals section. We'll recommend to a user, in this case Lindsay, that she have an emergency savings of $2,500. We're using 4 months of expenses, but that's something that can be customized. And we're telling her to contribute $4 a day to achieve the goal at age 34. And so we're drawing on a lot of the success that Acorns and Stash have had around micro savings. $4 a day is $120 a month. $4 a day just seems much more palatable, and we've seen an uptick in converting from that sort of monthly contribution to a daily contribution. So I can set up my daily contribution. I've got the summary where we're predicting, we're sort of pre-filling the 2 accounts that people are using. In 3 clicks, I've set up a goal. I know how much I need to save. I know how much I'm going to save on a daily basis, and that account is now funded. So those are sort of my 3 hypotheses around the problem, and sort of 3 tools within our online banking software that kind of help address it. So.
And I think from the user experience, what's really neat about the solution is Kobe's focused on saying, hey, these are the things that you need to address, right? So if you're going to go negative, you need to adjust your spending about that. But now that is taken place, it automatically pops up sort of the recommendation around the savings tools, right? And so you no longer have to be sort of proactive about digging in through those clicks, right? But having the institution make some recommendations about what's best for your financial behavior and just sort of shift that.
All right, thank you. So questions? I think this is a great conversation. Just 2 examples of a way to solve that problem. I'm sure there are other ways. Questions, thoughts, suggestions? Sir?
I heard it mentioned in an earlier panel earlier this week that the underbanked and the unbanked in particular have a lack of access to digital tools in particular. Do you have any thoughts around how to get your tool or tools that, Julie, I know you mentioned something very specific to what you've done, but how to get people into these tools in the first place?
What I can say is we had a company that focused on creating a digital wallet. So this was for unbanked. If you're banked, you can obviously create a digital wallet and have Apple Pay solutions and everything else. But for the unbanked, how do you create that digital experience? And so what they created was a platform that enabled you to pay with cash at a retailer. So imagine you go to Walmart, its purchase is $17.20. That $20 bill that gets handed to the cashier, the change of $2.80 immediately shows up on your wallet in an attempt to do that. It's been challenging, and I also know in talking to the MBTA and trying to get transportation services, which is a major unbanked population, to get them to shift into a wallet has received sort of similar difficulties and quite a bit of backlash. I believe it was Chicago who automatically enrolled people in savings accounts, and there was, he was nodding. for those of you who missed it. So I don't know what the right answer is. I know that there has been multiple attempts, again, to try and lower the bar to accessing a financial tools for the unbanked.
So that is a serious problem. Some of the research that we've actually done, it's very expensive to be poor. You literally pay 3 or 5% to cash your check. Then you count out your money and you go back and you pay $3 to pay a bill. In fact, we estimated that the monthly cost to not have a checking account is about $30 a month, which coincidentally looks like an overdraft fee.
Yeah. Right.
But the overdraft fee as a penalty when you make a mistake is very onerous on a family who's living week to week on paycheck, and it might actually mean whether or not they have meals to actually serve and put on the table. So that's the reason why the families revert to cash, because they can at least control the outcomes for themselves. I have seen different softwares that are available, but if you actually go to some of the gateway cities that just, from our own experience and our research, I mean, every corner there's a check casher. But there are tools that are being developed right now to offer small dollar loans. But it's funny how capitalism finds a way, because there are loans that are being made on egregious terms to actually meet the need that's actually delivered there. So I think there's a lot of opportunity. You had the quote as far as the billions of dollars that are being paid in fees by consumers. So I think there's a tremendous amount of opportunity right in that space.
Jim, I wonder if, do you think that some financial institutions would not have an incentive to help their people save because they make so much money off of their fees, like something like Bank of America or Wells Fargo? Like, would they actually prefer that their users be hitting fees all the time? And is that going to be a hurdle for people that want to help savers?
I don't think so. I mean, the challenge right now as far as small dollar lending are the limitations. And so that's on the regulatory side of things. As far as the state of Massachusetts is concerned, the maximum you can charge is 21%. But you're talking about if it's a $700 loan and you pay it off in 90 days, the revenue that's actually made off that as compared to what the potential for loan loss is if a loan is not paid off is where that's what needs to be solved. So that's why instead an overdraft is funding an emergency instead of a small dollar loan. Automation truly is the key in being able to get around and control a lot of things that I don't know if so when we were talking about how we actually, the bank actually cannot lose money by advancing its employees $1,000 loan. It just can't. I mean, we have a minimum wage for our organization of $15 an hour. And so if any employee has accrual of vacation time, if they end up leaving, they've got their 2 weeks pay that they've accrued when they leave. So there is absolutely no way that the bank is going to lose money by advancing people their money early. So if someone can solve around that spot, that's where the opportunity is.
Yeah, that's super cool. I think to your question, JP Morgan, I believe they collect more fees than anybody else, somewhere around $1.9 billion a year. And Bank of America is around $1.3 billion in fees. So it's substantial. But I think that they know that those numbers are going down and have to go down over time. But you're right. Where's that profit going to come from? So.
And sorry, as a non-banker, but I work with them, they're under a ton of pressure. They're very risk averse. They have a lot of hoops they have to jump through, as opposed to the payday lenders who are happy to send you money. I had a family member who had just rolling payday lending, and they were paying through their nose, and they never got ahead. The other thing is there is no silver bullet to solving this problem. So understanding, how many of those overdrafts are because they didn't realize the money was already spent, even though it was in the account. There's there's an education that needs to happen around understanding money more, I think, in my opinion. Did that help? Yeah, okay.
I think, though, the numbers about the fees that people pay should excite the people, especially in this room, because that means that money is already being spent in a way that it shouldn't be. Yeah. And if you can help people reduce that, they'll come to you and not go there.
Sir?
Talk a little bit more about the inertia issue far as results? You know, are people actually starting to save that wouldn't be those early adopters? What do you see in that?
So I guess the biggest thing for us was when we originally launched our Future Look tool, when we saw that reduction in planned spending of 38%, where we saw that those dollars allocated towards were goals. And in particular, among our user base, was towards the goal to buy a house. So we weren't in market long enough before we kind of hooked up with DCU to sort of follow through with, you know, how much of those dollars actually ended up in a savings account. But we definitely saw the initial traction from, you know, oh shit, I'm spending a little bit too much and I probably should be saving more as a result of the insight through the Future Look tool and the direct impact that it had on increasing savings.
Is that something you pushed down so they'd see it, or they had to come in and say, I want to understand this, I want to see it?
It was really a core feature of our product. The Future Look component was kind of our main value proposition when we launched originally, and that was how we were getting users because it was sort of a different feature at the time. This was going back 3 years. So folks were coming to us for that feature in particular.
Excellent. Anyone else? Oh.
Fine. Right.
Savings, do you use any kinds of encouragement, you know, like when you win points in computer games and, you know, game stuff, so you get a feel? You know what?
Yeah.
Do you do a lot of this? Could you do more? Have you looked into it? What do you do making people feel good about the small goals?
Yeah, we're not doing anything from gamification right now, and I see someone from Commonwealth right there. We're not doing anything with gamification right now, certainly on the roadmap, and I think it can definitely sort of help increase the traction we get of people committing to save, but sort of continuing to follow through with the savings process. I know one of the things with Acorn is, you know, they do a great job of getting you hooked on the kind of small dollar micro deposits, but I think they have an issue of that money just sort of coming right out, you know, days or weeks later. So you sort of need that gamification piece, I think, to get the follow through. We're not doing anything there yet, but definitely on our radar.
Do you guys have a view on what these new startups like Gain and Bridget and Earning their overdraft protection cash advance apps are doing? Do you guys have a perspective on that?
In what way?
I mean, a lot of people, so the premise is like they're going to give you $500 when your checking account potentially reaches zero to protect you against overdraft fees, and then you pay back with no interest, and then there's the option that essentially free or there's only $1 subscription. But there's a lot of people that say this is like hidden implicit user. So it just sounds similar to what he's trying to do, which is, you know, make people smarter, protect these steps one step further, and protect me against overdraft fees that large, multi-billion-dollar things.
Yeah, so I think it's interesting. We were just in an analogous conversation that DCU for 20 plus years, 30 years was paying people 2 days in advance of their paycheck. And that was nice. You know, no one really knew about it. They advertised it to members. And then now there are companies who are building entire businesses about getting paid a day faster or 2 days faster. You know, DCU, not to the extent of Redding, but if you are a new customer or a customer more than 6 months, you get immediate access to a personal loan should you need it for an emergency situation. They upped the numbers. I believe it's $1,000 for less than 6 months of a customer and $2,500 for more. So what's really, I think the impact is how do you get scale? And I think that these fintechs have been able to do a very good job at marketing these solutions by coming up with these sort of point solutions for folks, like Acorn has and others. So I don't know if a tool is necessarily going to change this problem at a macro level or not, but potentially all of these things can help small groups get just a little bit better.
Sir?
Yeah, I'm just curious, are you guys looking at tools or business coaching tools for independent workers? Is that group of independent workers? Is a big group. It's
Yeah.
28 people. And I have a hypothesis about that as well. With, that holds people back, in my mind, from building that net worth over time.
Mhm.
It's one of the hurdles that they have with starting a business, is because, just like you're saying, as a micro business owner or independent owner, you don't know the ins and outs and the time value, the timing of money. You don't know what's due. And I'm just curious, are you focusing only on consumer, or are you doing anything around business coaching for not independent?
So I mentioned part of our product includes advice and guidance around sort of the optimal or most efficient allocation of your resources. And we consider your tax filing status. So if you're a 1099 contract employee, we actually consider that in the advice and guidance that we're providing to you. So it's not just a standard, I guess, W-2 employee. We're also considering that. So that's one way we're kind of helping the independent contractors. We do provide sort of a small level of business banking services through our software today. The Future Look tool, I think, is certainly applicable to anybody that's running a business. You want to know what your cash flow is going to be 3 months down the road, a year down the road, as you're considering hiring decisions and things like that. So I think a lot of like what we've built today for consumers is also applicable to independent contractors and folks that are running their own company.
We had in the center just the other day Karen Mills, ex-Obama cabinet secretary member for Small Business Administration, and she pointed to that in the sort of 30-plus year decline of small businesses in America as a sort of significant strategic issue of strategic importance, right? And how do you address that? So certainly something that smart people have on the top of their minds. I know that there are entrepreneurs right now who are working on it, maybe not at the solopreneur level, but the small and mid-sized business level. One of them is ex-founder of Mineral Tree. His new company is explicitly trying to create opportunities for small and middle market business to have better insights into their cash flow. And I know that there's a lot of entrepreneurs who we've seen, including some in our space, who are trying to provide sort of support services and infrastructure around freelancers in the gig economy. So whether it be from an insurance perspective and should they get sick or whatnot, to be able to easily access insurance to cover any kind of losses, to folks who are developing tools. So I think it's less about, from my perspective, about delivering the digital products can enable these things. It's about how can these entrepreneurs create partnerships with institutions to be able to offer those in a way that's economically viable for everybody involved. So that's the bigger hurdle.
In respect to people's time and schedules, we're going to call that the end of the session. We'll be here for a little while. I want to thank Boston FinTech Week for being able to present this, and I hope everyone enjoyed themselves throughout the week. Thanks.